When Europe's venture market froze, one asset class suddenly became irresistible.
I find it quite nice to have the word sexy with secondaries, bearing in mind that a few years ago nobody wanted to really talk about this.
But behind the hype lies a brutal market reality.
Everybody's selling at the moment. Everybody needs some liquidity.
And liquidity always comes at a cost.
First of all, I would say you should assume there is a discount. There is a liquidity discount.
So how do you unlock cash without destroying future value? The answer lies in surgical precision.
So our preference would be to cherry pick.
But the real innovation, a deal structure that gives sellers what they need most, cash today, upside tomorrow.
So we find a solution where we will buy 10%, they retain 10% of the assets, so they get some liquidity, but they also have some kind of upside going forward.
It's a formula that's reshaping European venture, and one firm has bigger ambitions.
Become the biggest secondary direct player in Europe.
How did cherry picks and strip deals become the new path to liquidity? Join us as we decode the mechanics behind Europe's secondary revolution with Olav Ostin, founder of TempoCap.
Before we start the show, a quick note. If you're building or running a fund, you know it takes the right partners. At EUVC, we only work with sponsors we truly believe should be part of your tech stack. Please do take a moment to hear about them. And if you do, reach out, mention EUVC. It's the best way you can support what we do. Thank you so much. Starting off, HSBC Innovation Banking. If you're a founder, a scale-up, or a VC, you need a bank that actually understands your world. HSBC Innovation Banking backs innovation globally, from seed to IPO. And if you ask me, a strong banking partner like HSBC belongs in your stack. If your portfolio companies are scaling, they need infrastructure that won't slow them down. Google Cloud Starter Program offers $2,000 to $350,000 in credits, plus technical support to build better and faster. It's a key boost every fund should bring into their ecosystem, and oh my God, are we thankful to be partnering with them. Now, legal is a space you cannot lag on. Legal needs to move at the speed of venture. Goodwin's team has decades of experience with startups and funds. They're trusted at every stage from formation to exit. Goodwin definitely is a legal partner every serious manager should have in their stack. For Luxembourg-based VC, PE, and fund-of-fund managers, modern funds means going digital. Fundcraft gives you a full-service, digital native platform built for today's European managers. It's a must-have if you're scaling smart. So we all hear about the Middle East. How about you go there? From AI to deep tech to sovereign fund, Skytech in Dubai is where global future of tech gets negotiated. It's not just a conference, it's where East meets West, capital meets innovation, and the bold set the agenda. If you're playing on the global stage, join us going to Skytech this year. If you're gearing up for a next fundraise and want a placement agent who truly understands emerging managers, reach out to C Funds. They're a boutique placement agency that has helped GPs across Europe raise capital from top-tier LPs. We've been on the other side of the table here. They are actually good ones to work with. So I do urge you to go to cfunds.io to go and check them out. And hey, before you go, if you're looking to discover startups, raise capital, or connect with innovation leaders, do check out dealflow.eu, the EU-backed platform bridging founders, VCs, and corporates. There's no better place to find the startups that have received significant funding from the European innovation ecosystem.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
Today, we're diving into the surging secondaries market with Olav Ostin, founder and managing partner at TempoCap. As the secondary market hits record highs, Olav offers insights into the dynamics reshaping European venture and what it means for the future of liquidity and exits in our ecosystem. We, at the time this episode goes out, will just have launched Joe Short's talk from the EUVC Summit, where we also talked about secondaries. So I'm looking forward to contrast what he said compared to what you're saying. I imagine it's somewhat similar because these days, Olav, everyone's saying secondaries is the place to be when it comes to venture in Europe.
Yeah, well, thank you very much for having me on the show. Delighted to talk about secondaries.
Tell me, Olav, first and foremost, a bit about your background so everyone know you. TempoCap, when did you hit the market? What have you done since, so on?
Yeah, so we set up TempoCap in 2016. So it's been 9 years now. We've been doing secondary transactions for the last 9 years. We are a team of 12 people with an office in London and Berlin, and hopefully next year in Paris. And we do two types of secondary transaction. We either buy entire portfolios of investment for people who look for some liquidity, which is most people these days, or invest in single asset secondaries, later stage companies. I'll explain a bit later in more details.
Well, maybe that is where we should start, because the mechanics of secondaries, not everyone are super well versed there. So let's describe those two in detail, and then maybe talk about why you're focusing there instead of, as an example, LP secondaries, which is a big isomer thing.
Yeah, so what we do is called secondary direct. Why secondary direct? Because we go directly into the companies. As you say, you have LP position, you have GP led. We're also active managers, so we're exactly like VCs after the transaction. We sit on the board of the companies, manage them for a period of 3 to 5 years until exit. I would say recently the market has exploded with a few players coming into what we call single asset secondary direct. So where you have some VCs who are just doing primary investment and are finding it now quite sexy to do secondaries. I find it quite nice to have the word sexy with secondaries, bearing in mind that a few years ago, nobody wanted to really talk about this. And then you have very, very few players buying entire portfolios of investments like we do, because it's technically quite complicated to buy 5 or 10 companies in one transaction.
Yeah. And maybe just talk about deal size here. What size deal stage would you look for in companies?
So we look for companies that are later stage, how we call them. So we look for companies that have more than 10 million of ARR. So normally when we invest is kind of 10 to 30 million of ARR. I speak of ARR because 90% of what we do is enterprise software. And we look for companies that are fully funded. Doesn't mean that they have to be profitable, but what we want to see is with the cash they have in the bank, they'll get to profitability over the coming years. And the main reason for that is it's obviously quite disruptive to look for some new capital. And also our business model is really trying to invest in technology with limited risk. So if a company is mature or reasonably mature and is fully funded, we've established that there is lesser risk of failure. And at TempoCap, we haven't closed the company for the last 5 years. So this has worked reasonably well for us. In terms of sectors, perhaps also, we do quite a lot in cybersecurity and defense. As one sector, we do quite a lot in fintech. And we do, in general, quite a lot in enterprise software, horizontal or vertical. So that's probably 90% of what we do. And then from time to time, we will do some other sectors like digital health. We were investors in Depop, which was not an enterprise software, but a great deal for us. So in terms of stage and sector, that's where we focus on mainly, and mainly European companies. But when we buy a portfolio, we're happy to also have kind of a US company in the portfolio.
And a transaction size?
So in terms of single assets, it's probably 5 to 20. We'll probably start with 5 to 10, I would say. And then what we like to do is extend through more secondaries. So a great transaction for us would be to start at 7, 8, 9, and then double down over a period of time with more secondaries in the company, and potentially supporting the company also afterwards with some primary capital so they can expand. It's not because we're doing secondary that we're not prepared to do primary investments in the companies also. And then in portfolios, more complicated transactions, taking more time. Minimum for us is really 20 million euros. And there's no kind of top. At the moment, we're looking at deals of over 100 million. We'll see if they take place. There's been a big shift recently in terms of size, but the minimum being 20 there.
How does a deal come to you as a secondaries investor? Like, do you prefer to hunt them yourself and kind of you have your targets that you have top of mind? How much do you source by collaborating with VCs in the ecosystem? When is it that a company comes to your map, so to say? And what do you want to say to the GPs that are listening in terms of engaging with you?
Yes, so, two types of transactions, single asset and portfolios. I would say on single assets, there's quite a few primary investors who will also do secondaries. And then you have a few new players who are VCs before and have raised a secondary fund, or also what you're starting to see is LP investors who will raise a secondary fund based on the recommendation they get from their GPs where to invest. So I would say on single asset secondaries, there's probably kind of a broader number of players. And there we get most of our deal flow by sitting on the board of companies, knowing VCs in Europe, and looking at quite a lot of primary rounds also. We are not against participating in primary rounds, so looking at primary rounds with secondaries. And then we have this strong sector expertise, so probably in the sectors we know well. In portfolios, it's completely different.
Just a follow-up question there. Do you do a private primary round without a secondary component to it, or is there always a secondary? No,
we'd be happy to do this. On single assets, what we're looking for is investing in the best companies we can find. The beauty of secondaries is you can invest anytime in a company, in theory. So we're looking at a company that just raised quite a significant amount of money in the UK. I was talking to the founders recently, and they're saying there might be more secondaries to be done on the back of this primary round. And also sometimes there's a primary round, there's no secondaries, and 6 months later someone calls us and say, well, we really like the interaction we had with TempoCap. Would you still be interested to do a secondary? So this can happen pretty much any time. In terms of portfolios, it's very, very different. So there's almost no one in Europe doing this. And so TempoCap is known as being capable of buying 5, 7, 8 companies in one transaction, which is technically very difficult, bearing in mind preemption, co-sell, and the difficulties of closing one deal with 8 companies, underlying companies in one transaction. So I would say in this market, we get a lot of inbound calls at the moment from corporates. We're having lots of discussion with CVCs, corporate VCs, and with VCs in general, who are looking for some DPI. Everybody seems to be kind of needing some DPI at the moment.
Let's drill further into this dynamic. Let me first ask, when you do a multi-asset purchase or investment, typically is it in the shape of buying a full LP portfolio or VC's portfolio, or do you cherry pick within a VC's portfolio and you leave the ones that you don't want, but you do, it's still a multi-asset purchase because it is more than one, but you typically don't like to buy the whole suite of the remaining portfolio. How do you normally do?
So our preference would be to cherry pick some assets from the portfolio and then find a reasonable kind of pricing around these assets with the seller. It's not always possible to do that. And I would say, depending on situation, the dynamics can be very, very different. If you have a CVC, for example, corporate VC, they will often come to the table saying, we are discontinuing the operations. We have 15 companies. We understand you're only interested in 5, but what are we going to do with the rest? So then we have a discussion on, well, you understand that for us, the other assets perhaps have very little value. It might be better to sell them to management. But there'll be a dialogue. The idea is really to try to build a liquidity solution with the seller. Yeah, we're not going to impose our terms. People are not imposing their terms. These are really tailored solutions where you try to understand kind of the needs of the seller, and then you try to adapt and find a deal that is a win-win situation for everybody. In VC portfolio, it's very, very different. You might be talking to a VC that is in Fund 7, I make it up, and in Fund 4 or in Fund 5, they still have some assets, and this is mainly driven by the need to do another fundraise and the LPs putting some pressure into the VC, to generate some DPI. And so they come to us and they say, well, ideally we wouldn't want to sell anything, but the reality is the exit market has been tough over the last few years, and so we need to generate some liquidity. So again, here it's very much of a tailored kind of proposal. And normally this is kind of tailored around a few assets, unless there is a clear need to shut down one fund, but it's very, very rare. Normally, it's really DPI driven, and you can have also what we call strip deals, so where you share the shareholding. So let's say VC has 20% in one company. We consider it's very attractive. They are telling us, listen, if we sell the entire stake, this is a big upside for our fund. So this is a bit of a problem. So we find a solution where we will buy 10%, they retain 10% of the assets, so they get some liquidity, but they also have some kind of upside going forward.
And I guess it also tends to be a better option when it comes to the founders, because hopefully the founders are already happy about the existing investor, and they, as much as they would love to welcome TempoCap, I'm sure, to the cap table, they are happy about the existing investor that's already been on a good journey with them. And for that reason, maintaining them.
Well, it's not always the case, because if you have a fund that is out of cash, and the company is doing well, and they want to do an expansion round, they're much rather having us with fresh capital. There's a new round of funding. We can participate in the round of funding than a VC fund that is after, I don't know, year 12. The company is doing well, but it took a long time to take off. And this fund is kind of not in a position to join the new rounds. It might create some tension because, so it's not always kind of black and white like this. Of course, there's always a question of, who are these guys? I mean, I've been working with this investor for 3 years, 5 years, 7 years, 10 years, and suddenly you're replacing someone in the relationship. So the fact that we do a lot of single assets, the fact that we sit on lots of boards, the fact that we have some sector expertise really helps also kind of bridge kind of this kind of gap and make everybody comfortable. And the idea for us is that to make the transition very, very smooth always. And also we're quite value added. We have 3 partners here who are 100% operational to try to help these companies grow. So this is also a surprise quite often from companies. They expect secondaries to be 100% kind of financially driven, but we are really like kind of an active VCs trying to help to grow the companies over time.
Yeah. I'd love to ask you a bit about, let's call it not best practice, but rather bad practice or misunderstanding, misconceptions around secondaries. One thing as a beautiful example, I think, is when I talk to VCs that are not super familiar with secondaries, they often think that secondaries are synonymous to a discount. And they often, when you hear them talking, it's very quickly, how much should I expect of a discount on this and blah, blah, blah. And then the funny thing is, whenever I talk to secondaries investors, they always, the first thing they say is, discounts is never where we start. Discounts is contingent on whatever we find out about the company and what we believe about the company and where it stands today. So it's never, well, because this company is this old and it's in this market, blah, 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 expect 20% discount. Like there are no rules like that. So I'd love to, if we start with that one and then we continue into the things where you are seeing that when you engage with VCs or founders around a secondary round, that this is where we often need to explain the dynamics or how we come to it.
First of all, I would say you should assume there is a discount. There is a liquidity discount. If you invest in an asset class that is illiquid and you want to get out before the company is sold or IPO'd, there is going to be a liquidity discount. If you're on the stock market, it's exactly the same thing. If you own some shares in a kind of a listed company and you want to sell a block of shares, the broker is going to tell you, yes, I can do it off the market, but there is X% discount. So this is kind of not very, very unusual, I would say. So I would say in general, there's always a discount. We've done some deals where there's no discount because, let's say, there's been around a year ago and the company has grown by 50% in the last year. For us to ask for a discount didn't seem to be fair or even reasonable because the company has grown quite a lot since there was a last pricing. It's fair to say it also very, very much depends on how the valuation is computed at the sellers. A lot of CVCs, corporate VCs, will keep the last round of funding. So you can just imagine, in 2021, the average transaction was done at 15 times revenues. While over a 10-year average, we can see that the revenue multiple is 5 to 6 times. So it's not me saying it, it's the numbers. There was some overvaluation in 2021. And if you have a corporate VC is trying to sell a good company, but that hasn't grown exponentially, even though, imagine if it's doubled, you pay kind of 15 times. So, you are paying now 7.5 times. It's still more than what you're getting on exit, which is 5 to 6 times. So you're going to have to see a discount. So here, if you're starting with the last round, it depends very, very much what the company has done since then and what was the pricing at entry. A lot of VCs are marking to market. So on a quarterly basis or every 6 months. And there you have different type of disciplines. Some VCs are conservative and we find a portfolio of investment where we don't really see the need of a big discount. And other situation is completely unrealistic. And actually, if you ask LPs, they can say that between GPs, they have a valuation that, it goes from simple to double. I would say on our side, what we try to do is try to see what is the exit pricing you're going to achieve for an asset. And then what we are kind of factoring is the multiples we'd like to achieve on this company, which is normally our target is to achieve a return of 3x. And so this gives us an entry price that we want to be paying for a company. Of course, if the company is going to be sold in the next 12 months, you can't expect to do 3 times the money. But I would say we work much more on this basis of what is the exit pricing we can get in 3, 4, 5 years, and therefore what's the price we should pay today. And we've just offered to buy quite a large portfolio between 50 and 100 million, where the seller didn't give us its NAV or book value. And they said, well, quite rightly, you guys, you say you're expert, you can value. Well, I'll give you all the data you want, and you tell me the price you want. And it's quite interesting. So we put a pricing, and then we discuss, and then we discovered the book value. And we ended up with a bit of a discount, but it wasn't outrageous. But then the seller felt much more comfortable that we had done a proper analysis of the portfolio pricing. And so we are now engaged on discussion, see what will happen.
Is that a rare dynamic, or is it something you see once in a while? How did you like it? Do you think it was actually beneficial for the process or not?
No, I would say most of the time people will share their reporting. And they will say corporates are normally really straightforward, because why is there a portfolio transaction with a corporate? You need one of these 3 factors. The first one is the corporate is not doing well. So if it's not doing well, it doesn't want to have a corporate VC fund of 100, 200 million. It wants to cash out. Second factor, there is a new management team. New CEO, new CFO, new COO, and they simply don't want to have a CVC. It's for them, it's kind of non-core. They don't want to spend the time reviewing the assets. So they strategically, in these 2 scenarios, they're basically saying, by Christmas, I want this portfolio out. And then they give all the information they have, and they say, well, find a solution. I just want to have a fair process. And then the third reason, which also happens sometimes, is the portfolio is not delivering what the corporate was expecting. Either they wanted to have some kind of deep understanding in some technology that they're not getting through the CVC, or the financial performance is not in line with what they were expecting. So you need one of these kind of 3 scenarios to have a transaction that takes place. And normally, I would say corporates give you a lot of information. In terms of VCs, it depends. So you have some VCs who say, well, you've cherry-picked 5 companies in my portfolio of 20. You seem to say, you know what you're doing, so I'll give you the information, you give me a price. Since you've cherry-picked, it doesn't seem fair that I'm giving you the NAV of all the companies. And fair enough, that at the end of the day, we'll need to get the NAV because to close the deal, but we just don't need it at the start. And some of the VCs just send their entire reporting and say, we just need some liquidity. Can you do the cherry picking? Tell us what you think. And then we'll engage on this basis. So again, there's not really a rule. Most of the transactions we have are bilateral discussions. You don't have a process. You just have a counterparty saying, we'd like to discuss a liquidity solution.
Is it a usual process, so to say, that a VC will reach out to you and say, we have a need to generate liquidity? Are you interested? Basically go to our website, see the logos that are there. Does that look like something that's interesting for you to dive deeper into? Is that a similar origination of the conversation?
No, I would say most of the time, if they call us, we will sign. So the process is perhaps to explain to everybody the steps. We normally have three main steps. So the first step is what we call a desktop analysis. So we'll sign an NDA. We'll get quite a lot of information on the portfolio. Most of the time, we know the underlying companies because we are active in primary and secondary single assets. So there's a portfolio of 10 companies. We'll probably have met already 5 companies in the last 3 years. And so we will spend quite a lot of time going through the portfolio, establishing what is the perimeter of the portfolio that should make sense for everybody. Sorry, the price. And then we have kind of a feedback with the seller, a discussion. And this is a very important step because it's completely confidential. So someone can come to us, share this information. If we don't agree, the market will never know we have spoken. And that's super important. I think before there's an understanding on the deal terms, it's very important that these discussions are extremely confidential. If we agree on the deal structure and on the price after this first step, then what we have is kind of a due diligence or confirmatory due diligence. So we meet the top assets to confirm that what we've been told is correct. So at that point, the transaction is not kind of public, but there's less confidentiality because TempoCap will meet a few of the companies to confirm that commercially what we understood with our desktop analysis is correct. And then at the end of this process, we will confirm pricing and we will confirm that we want to close a deal. Also, normally in the second phase, we agree how we're going to transfer the assets. Transferring the assets is very complex and you need to find a way where it's very, very smooth for the underlying companies. And then we execute the deal. Phase 2 is kind of confirmatory due diligence and finalizing the structure and the pricing. And phase 3, you just execute the deal with an SPA and then you transfer the assets, which interestingly can take quite a lot of time sometimes. Phase 3 could take 1 month, but it could take 3 months because transferring the assets can be complex in the type of deals we do.
Any other important misconceptions that we should get to before we move on?
Yeah, I think there's one important point to mention is our preference is to work with the incumbent GP. So most of the deals we do on a portfolio basis, our very strong preference is that the GP remains in place and then we work together. So we are GPs also, so it's not like it's us and not them. So our favorite structure is that after the event, we have some kind of partnership, we have one investment committee and together we manage the portfolio, which is, as you said earlier, it's a smooth transition for the underlying company. For us, it's also make sure that there are no skeletons in the cupboard. It helps us also to manage better the portfolio going forward. So I think very often people think that if we get involved, we're going to want to do everything. This is not our preferred transaction structure.
Everyone's talking about this pending destruction or collapse of many funds in US venture as well as European venture. We've all seen the stats of all the funds that don't manage to raise the next one. I'd love to ask you, and you've described it here already, I've heard the same thing with regards to corporates, that there's a lot of fire sales of corporate portfolios happening. I'd love to ask you, what are you seeing, and are you seeing that there is real market signs in what you're seeing on a deal flow level of funds wanting to wind down or needing to wind down?
It's not necessarily a fire sale. I wouldn't use this term personally. I think there's been a huge explosion of investment from corporate VCs in the asset class. Just to give you an idea, in 2014, CVCs, corporate VCs, invested $18 billion in venture. In 2021, they invested almost 10x that, 173 billion. And this is the peak, but 22 was quite high, 2020 was quite high. So it's just that we had an unprecedented amount of capital that came in the asset class, unprecedented. People talk about VCs going nuts in 21, but actually CVCs invested a lot in the asset class. And so now what we're seeing is kind of a natural pace of exit required. These funds have not had exit in the market, and their owners are saying, well, we've invested a hell of a lot in 2020, in 21, 22. We need to start to see some cash back. So I would say it's just a normal kind of course, and it's probably going to take 5 to 10 years of secondary transactions before you go back to normality with the corporate VCs. With VCs, I would say it's not a 10x, but it's probably in Europe a 3x increase. So big increase also. And like kind of any evolution theory, some are going to make it, some are not going to make it, because there were a lot of new funds. I think we very rarely deal with VCs that are going to shut down. Because basically, if they're going to shut down, they've raised one fund. Out of 10 companies, they've got one good company or two good companies. The GP is going to try to remain the manager for a very long time because this is the only assets they have. If they raise the fund, let's say in 2018, it's probably 10 plus 1 plus 1. So it's 2028 plus 1 plus 1, 2030. So we'll probably see these funds, if they're still kind of there with the assets, in 5 years' time. So again, what we're going to see is probably a 10-year period from now where we're seeing this transaction take place. At the moment, we're seeing very few VCs that are closing down, on our side at least. I think there's probably quite a lot of VC who can't fundraise and so are not investing anymore. But they're not coming to us because the assets they have, they want to keep holding them. It's very rare that the GP said, well, I used to be a VC, now I'm going back to corporate, or I'm going back to creating a business. What we're seeing mainly is kind of VC funds who are kind of vintage 2015 to 2018, fund 3, 4, 5, or even more, and needing liquidity to raise their next fund. Most of the VCs we're seeing are very good VCs. And actually, in my view, it's quite a positive sign in the industry. It's a sign of maturity that you're considering kind of secondary as an option for exit. If you look at the buyout industries, they've been doing this for years. And they've been doing this very well, selling kind of their companies to other buyout investors. So it's just a sign of maturity that we're seeing in Europe, this kind of transaction happening.
Sometimes in the States, the private market is being described as now so liquid that for many good assets, you no longer really have to go public because you can raise the money that you need and you can get out of it at pretty good terms with secondary investors as well. So for that reason, we might see a complete redefinition of the border between private and public. Do you see us in any way nearing that in Europe, or is that still miles away?
So for us, it's completely irrelevant. In a company, if it stays private for longer, the only thing you'll see is the guy getting divorced or the personal situation of one investor's changing or one employee in this company having left the company wanting some cash to buy a boat. So there's always special situation where someone wants some liquidity. If anything, if the companies are staying private longer, you're going to have more need for secondaries. And then if they are bigger, yes, you have some platforms in the US or mainly for US assets, where you can buy these kind of shares on these platforms. I mean, we focused on companies with valuation normally 50 million to 250 million, sometimes in portfolios a bit higher. On these platforms, I would say all the companies have a valuation of $1 billion plus. In Europe, if you start investing in only $1 billion plus companies, you're never going to make any money. The biggest cash exit, do you know what's the biggest cash exit in Europe over the last 5 years? What's the amount?
That's a good question. I don't know.
2 billion.
2 billion.
Okay, 2 billion. So basically, in Europe, you don't have a lot of cash exits first, and the one you haven't been that big. So the US market is completely different. You pay a much higher price on entry, and then you expect a much bigger price on exit. So it makes sense to have these secondary platforms allowing you to buy in a company, at 1 billion, 5 billion, even 200 billion in some cases. In Europe, where the exit market has been, at least historically, much lower, unless you're talking about Revolut today, which is kind of a unique situation, I would say. It's very, very risky to kind of start trading in companies at 2, 3, 4, 5 billions, and companies at 2, 3, 4, 500 million. These platforms are not interested because the volume is not big enough to generate some commissions.
Now, I'd love to ask you about, because you have had some quite notable exits in TempoCap's portfolio recently. You've had a $650 million acquisition of Onfido, and then a $500 million acquisition of Dedrone, and I might be pronouncing that incorrectly. What do these successes to you reveal about the current state of the secondary market?
At TempoCap, we've had 5 exits over $500 million over the last 4 years, which is extraordinary because it seems that it's as much as any other VC in Europe. Well, we are not that big compared to the bigger players. So we're still seeing some exits, much less obviously than in 2021. The big difference is negotiation is tough. Terms are much more challenging, but there's still appetite to do some transactions, I would say. There's a lot of volatility in the market at the moment, a lot of it being created by kind of the US administration's position, which creates kind of bull market, bear market, bull market with kind of very quick successions. Our view on exits at the moment is it's still possible to exit good companies. We're finding that private equity players are much more active now than they were probably 12 months ago. You need very good metrics to attract them, but you don't have the big exits. I mean, kind of the multi-billion or billion plus exits at the moment are very, very rare. We track all the exits for cash in Europe, and they're on our website. We track all the exits for cash plus equity. They're on our website, and all IPOs. There's no IPOs. So I would say you still have some exits, but the price is much lower. In Europe, anyhow, most technology exits are between 100 million and 500 million. Obviously, they don't hit the headlines, but this is kind of the reality. And you still have quite a lot of them, simply much less than before. The other challenging part is we saw quite a lot of private equity-backed software businesses in the US looking at Europe for expansion. What we are seeing is very strong discipline from the private equity backers of these software businesses at the moment, because they probably overpaid in 2021. And what we also now are starting to see is debt providers in these companies, if they are leveraged, having a very strong say in the fact that they can execute a transaction or not. Having said all that, I think we'll have another few exits this year at good multiples. We've just had a recap at AirHelp, where we got a very good outcome with a great new investors, US investors called Abri. So it's possible to do deals, but they are definitely kind of more difficult and take longer than before.
Yeah. Let me ask you here, just 5 minutes before we close, what is the future like for TempoCap? What's the focus of you in the coming years? Where do you think that the biggest opportunities are?
Well, for us at the moment, it's we're witnessing something we've never seen. I hope it's going to continue. You can't expect it to continue forever. I was at a conference in Switzerland recently, and someone asked me, who's selling? And I said, that's the wrong question. It's who is not selling? Everybody's selling at the moment. Everybody needs some liquidity. So we're hoping that, and the stats shows that it's probably going to be a 10-year cycle from the level of investment we've seen in the last 10 years. So for TempoCap, what we want to do is become the biggest secondary direct player in Europe. We've had a good start. We've had very strong kind of results. I'm super proud to say kind of a 2020 vintage fund has a 0.9x DPI, which is kind of quite extraordinary. We've achieved more than 50% IRR on our exits. So I think the idea is to fundraise for a bigger fund and try to be kind of the European leader in this market of secondary direct. We're seeing the Americans are very, very successful in the US. You have great brand names like Industry Ventures, Top Tier. Pine Grove has just started backed by Sequoia. So it's always great to hear that Sequoia thinks the market is attractive, especially if they've put the partners' money behind it. So we believe that the secondary market is going to continue to be very, very interesting for the next kind of 10, 20 years. And hopefully with our head start, we can be the largest player in Europe and be a great partner also to entrepreneurs. The bigger we are, the more we can help our entrepreneurs to kind of expand in different geographies, help them go to the US. Ideal at some point, we'd love to have a kind of a stronger presence in the US or a partner, because our very strong performing companies need help to enter the US market. And if we can help them with that, that'd be great, as well as making money for our LPs.
Beautiful, Olav. Thank you so much for joining me today. And I am absolutely sure that the European secondaries market is going to be quite interesting for a few years to come. Thank you so much, my friend.
Thank you very much, Andreas.
Before we start the show, a quick note. If you're building or running a fund, you know it takes the right partners. At EUVC, we only work with sponsors we truly believe should be part of your tech stack. Please do take a moment to hear about them. And if you do, reach out, mention EUVC. It's the best way you can support what we do. Thank you so much. Starting off, HSBC Innovation Banking. If you're a founder, a scale-up, or a VC, you need a bank that actually understands your world. HSBC Innovation Banking backs innovation globally, from seed to IPO. And if you ask me, a strong banking partner like HSBC belongs in your stack. If your portfolio companies are scaling, they need infrastructure that won't slow them down. Google Cloud Starter Program offers $2,000 to $350,000 in credits, plus technical support to build better and faster. It's a key boost every fund should bring into their ecosystem, and oh my God, are we thankful to be partnering with them. Now, legal is a space you cannot lag on. Legal needs to move at the speed of venture. Goodwin's team has decades of experience with startups and funds. They're trusted at every stage from formation to exit. Goodwin definitely is a legal partner every serious manager should have in their stack. For Luxembourg-based VC, PE, and fund-of-fund managers, modern funds means going digital. Fundcraft gives you a full-service, digital native platform built for today's European managers. It's a must-have if you're scaling smart. So we all hear about the Middle East. How about you go there? From AI to deep tech to sovereign fund, Skytech in Dubai is where global future of tech gets negotiated. It's not just a conference, it's where East meets West, capital meets innovation, and the bold set the agenda. If you're playing on the global stage, join us going to Skytech this year. If you're gearing up for your next fundraise and want a placement agent who truly understands emerging managers, reach out to C Funds. They're a boutique placement agency that has helped GPs across Europe raise capital from top-tier LPs. We've been on the other side of the table here. They are actually good ones to work with. So I do urge you to go to cfunds.io to go and check them out. And hey, before you go, if you're looking to discover startups, raise capital, or connect with innovation leaders, do check out dealflow.eu, the EU-backed platform bridging founders, VCs, and corporates. There's no better place to find the startups that have received significant funding from the European innovation ecosystem.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.